With markets reaching all-time highs, a recent theme surrounding our client meetings has been when is the market going to pull back? And in anticipation of this, should we be buying or owning gold in some fashion? And I get it. There are numerous pieces to the overall equation, whether it be investors seeing their account balances hit all-time highs, whether it be a lack of volatility overall in the last few months, or wondering what is going on in the landscape around us. The reality is, I've actually had hundreds of conversations just like this over the last 10 years, and my answer, plain and simple, is gold might not be what you think it is. So today, I'm going to break down for you the specifics surrounding gold, how to own it, 4 common ways in which it's invested in, potential tax traps, in addition to the layers of costs and fees to be aware of. And I want to be clear that this is not a recommendation one way or another whether you should or shouldn't own gold in any fashion. Please consult your financial professional to understand what's in your best interest. Now let me start with something that might actually surprise you. I am not a big believer in owning gold to grow wealth. From the years 1971 to 2024, the return of the S&P 500 has averaged over 10% a year, while that of gold has averaged just below 8% per year during that same time. And over the course of multiple decades, that compounding can make a real difference. But where I see folks getting confused, or potentially having the fear of missing out, is when constantly you see in the headlines that gold is hitting all-time highs, especially between late 2024 and all through this year in 2025. But I personally look at chasing gold for growth similar to buying fire insurance on your home because your neighbor's home burned down and they received a payout. And with that, I've seen time and time again where when investors start to chase a hot theme or something that seems sexy, they end up feeling jaded because emotional investing tends to lead to bad outcomes. Generally speaking, there are 4 ways to own gold. So let's talk about the first one, which is owning physical gold. Whether it be coins, gold bars, or jewelry, I'm talking about gold in the sense that it is physical and you can hold, touch, and feel it, in addition to having a feeling of control. I have a client, and for the purposes of today, let's call him Tom, who when he first came to me had over $180,000 in gold coins in a safety deposit box. He said it made him feel secure, and I totally get that, because there is something visceral about owning the physical commodity and having the ability to feel and touch it. It doesn't include things like being involved with a fund company, a bank, or any other aspect that could create a roadblock for you. However, something that Tom did not fully understand was the potential for friction involved in owning the physical commodity. Whether it be trying to sell it in the event of an emergency liquidity situation, or the costs around buying, selling, or owning, Tom grossly underestimated what was involved. Truth be told, when you go to a dealer to make a purchase, they could end up marking up the commodity somewhere between 2 to 5%. And on the flip side, when you go to sell it, they could end up offering several points below spot value. Never mind the additional potential costs of shipping, insurance, and verification. All in, you could end up paying somewhere between 6 to 10% throughout the life cycle of owning this commodity, and that doesn't take into account tax consequences. Now, despite the fact that these expenses might not show up on a fund fact sheet, there is the real ability for them to compound over the course of time. With that, there are some that prefer to own physical gold, they're comfortable managing logistics, and they don't necessarily care about the fees or potential tax consequences. If those things do bother you, however, let's talk about an alternative, and that's owning a gold fund or ETF. This could be looked at as owning paper gold, where although you don't own the physical commodity, you own shares in a fund or ETF that tracks the underlying commodity price. When it comes to my personal experience, this is typically the most commonly used. As far as liquidity is concerned, you may be able to buy and sell during open market hours. From a fee perspective, there tends to be more transparency as certain disclosures are required. And as far as logistics, you can own these in both a non-retirement or a retirement brokerage account. But, as with most things in life, there are also caveats to be aware of. Owning these ETFs or funds inside of a non-retirement account can sometimes result in paying a collectible tax rate as opposed to a capital gains tax rate. That could equate to long-term gains being taxed up to 28%, as opposed to long-term capital gains rates, which typically fall somewhere between 15 to 20. And if you decide to go with an actively managed fund, you could end up experiencing capital gains distributions or additional layers of fees, which you might not necessarily be aware of or have asked for. Let's talk about another option that is interesting to some, and that is owning the gold miners. I want to be clear, this is not owning gold in any capacity, but rather owning stock in a company that digs the gold out of the ground. When gold rises, miners could end up amplifying that increase in value, and that leverage might be attractive to some. In addition, from a tax perspective, you're looking at capital gains, which again could fall somewhere between 0 to 15 or 20% on the high end. But here's the flip side. Mining stocks are still stocks, which could end up following the trend of the overall broader market. If risk appetite drops, or we go through a recession, or a steep market decline, even though gold prices might hold steady or increase, gold mining stocks actually could end up falling out. Because the fact of the matter is, when you own a gold miner, you have exposure to company risk, not just that of the physical commodity. Other things to be aware of as far as risk is concerned when owning these stocks could be rising costs, increasing debt levels, or operational failures, all of which could end up leading to the stock turning down as opposed to following the overall trend of the actual gold. In my opinion, if I'm looking for an inflation hedge or safety, quote unquote, I don't necessarily know that I'm going to go doing it by owning a gold miner. And option number 4 might be lesser known, which is that of the gold IRA, where you own IRS approved gold inside of a retirement account. Investors looking for tax-deferred growth, tangible assets, and the comfort of owning something physical inside of a retirement account might choose to go down this route. But here's what the sales pitch doesn't emphasize: the additional layers for potential fees. Oftentimes, you could end up paying a setup fee, a maintenance fee, and an ongoing depository fee to the approved holder of the actual gold. And after all that, you could still end up paying markups when you go to buy and markdowns from the dealer when you go to sell, which could add up over time. And although this might sound less than desirable, if you're looking to own physical gold as far as the commodity is concerned inside of a retirement account, this might be the route worth considering. Now, something to be aware of is once you hit the age where you need to take required minimum distributions or RMDs, you could have some sort of a liquidity situation occur or be forced to take in-kind distributions. And now that we've covered the 4 common ways to own gold, let's talk about some of the caveats around this that change no matter how gold ends up reacting. Picture this: 2 retirees, the same $100,000 gain, and 2 completely different tax bills. Why, you might ask? Well, as I mentioned earlier, the IRS does not treat all gold transactions equally. If you hold physical bullion inside of an account for more than a year, that is treated as a collectible. This can mean rates up to 28%, depending on your income. In addition, some ETFs own physical bullion as well, which could be treated the same way. So it's very important to understand what you own. On the other hand, if you own a gold mining stock for more than a year, any sales on gains are treated as capital gains, which at the long-term rate could range between 0, 15, or 20% depending on your income. You could go the route of owning gold inside of the IRA, as I mentioned earlier, in which case any growth or capital gains are tax deferred. However, with that, anything that you take out of the IRA is taxed as ordinary income. On the other hand, you could decide to own these investments inside of a Roth IRA, where all growth is tax-free and all distributions are also tax-free, provided you hit all of the requirement holding periods and time horizons. So, it's important to consider your structure, not just your performance, when looking at total return of these investments over time. Another important caveat is how each of these could end up reacting to market volatility. Being that gold is typically seen as an inflation hedge, if things go awry and the economy starts to do poorly or inflation rises, you could see the bullion hold steady or even increase in value. On the flip side, owning a gold miner stock could end up exposing you to market downturns, which you might not be aware of. Now let me provide for you the general framework I would use if I was trying to make the decision to own gold or not. First, I'd want to understand what matters most to me. What are my non-negotiables? Am I looking for liquidity and the ability to be nimble? Or is this more of a long-term investment in addition to my portfolio? Do I need tax efficiency? Or do I greatly value the sense of security in my mind in owning the physical asset? Next, I take a real hard look in understanding my target allocation. What exactly am I trying to achieve here? And where am I looking to go? Do I value the potential for comfort over the potential for growth? And will my legacy planning or cash flow be impacted by this decision in any way? And how will I choose the right rebalancing strategy or when the time is right to sell? Third, which type of account structure am I going to utilize and why? Am I going to hold this in a non-retirement oriented investment account? Or am I going to look to hold this in a pre-tax traditional account or Roth IRA? I personally like to think of gold as a seatbelt, not as an engine. And although you can have years like this year where we have seen gold move up considerably, I do not value it the same as owning individual companies. Gold itself doesn't have corporate earnings. It doesn't pivot its business model if needed. It doesn't provide insight into future financial metrics. And it does not innovate. With that said, everyone's situation is completely different, and some folks really like it. I personally find it can be very important to understand what you own and why. And while we can't predict the future of returns in the markets or investments in general, we can think about controlling from a certain aspect our tax ramifications, our level of fees, and the complexity of our overall situation. If you're trying to build your base and you don't know where to start and how to construct a portfolio, check out our next video here.